$1,394 to $88, silver in hours, conflict, oil, and Chinese demand. Said go up, someone said go down. $94 to $88 silver in hours, not days, not weeks, hours. While China's largest gold platform crashed under the weight of a nation panic buying. While the world's biggest oil refinery went silent. While 30% of global oil supply disappeared overnight. Every signal set up. Every data point screamed up. And then someone said down, who has that kind of power? And more importantly, what are they preparing for? Welcome to AO and AG. If this is your first time here, you are exactly where serious money comes to think, and if you have been with us before, welcome back. Now, before we go any further, subscribing to this channel is like putting on your seatbelt before the road gets dangerous. You would not drive without one, would you? So go ahead, hit that subscribe button, it costs nothing. What's coming might. And one more thing, where in the world are you watching this from? Drop your city, your country, even just your continent in the comments below. Because what is unfolding right now is not a local story. It is your story, wherever you are now. Let's begin. The alarm had not rung yet. American markets were still closed. The trading floors of New York were silent, but the data was already talking. Every weekend, while Western exchanges sleep, a quiet but powerful signal moves through the markets. Physical-backed cryptocurrency platforms, Kinesis, Hyperliquid, PXG, keep trading. No pause, no rest, no silence. And last weekend, those platforms were telling a very specific story. Kinesis Silver was trading near $100 alert. Hyperliquid had it at $96. PXG Gold was sitting at $5,400. Meanwhile, Western spot markets had closed Friday at $93 on silver and $5,278 on gold. That gap, that distance between what physical-backed platforms were pricing and what COMEX had last printed, was not noise. It was not a technical glitch. It was not a random fluctuation. It was a message. Those who understood the message prepared quietly over the weekend. They did not panic. They did not post. They simply positioned. Because here is what that premium meant in plain language. When physical-backed markets run through the weekend and price silver nearly $7 higher than where Western spot closed, that is informed money speaking. That is buyers who hold real metal, not paper contracts, telling the world what they believe the price should be before New York even opens its doors. This is called price discovery, and it was happening in real time. While most investors were watching television, Monday morning arrived, and exactly what the weekend premium had predicted happened. Silver gapped from $93 to nearly $97. Gold punched cleanly above $5,400. The ones who read the signal were already inside the trade. The ones who missed it were just waking up, reaching for their phones, wondering why prices had moved without them. This is not luck. This is not insider information. This is the discipline of reading what the market whispers before it shouts. But here is where the story takes its first unexpected turn. Because by the time most people celebrated the gap, silver had already begun to fall from $97 to $94 to $90 to $88 in hours. And the same data that predicted the rise was now pointing towards something far more complicated, far more deliberate, and far more important. There is a moment in every major financial event when the surface cracks. Not slowly, not politely, all at once. That moment arrived on a Monday morning in China. While Western traders were still adjusting to silver's gaps higher, something extraordinary was already unfolding on the other side of the world, something that no financial headline could fully capture in real time. China's largest e-commerce platform had just adjusted its gold price. The number it displayed stopped people mid-scroll, $5,174 per ounce. Not $5,300, not $5,400, $5,574. That was the price Chinese citizens were seeing on their screens while Western spot gold was still printing $5,946, a nearly $230 premium before the real chaos even began. Then the shelves ran empty. Major physical gold stores across China stopped selling investment gold bars entirely, not because they chose to, because there was nothing left to sell. What remained were decorative craft. Gold bars, ornamental pieces not meant for serious investment, being offered at the equivalent of 6,320 nais per ounce. Let that number sit for a moment. Western spot at 5,346, Chinese retail physical at 6,329. A $1,000 premium on gold in the world's largest gold-consuming nation. This was not a pricing anomaly. This was physical scarcity arriving in real time. And then the platform itself broke JD Finance, running gold accumulation products in direct partnership with Jiashang Bank on China's most powerful e-commerce network, crashed completely when markets opened to severe congestion, unable to log in. Unable to purchase, a nation of savers sitting on 336 trillion yuan had collectively decided in a single morning that paper was no longer sufficient. They wanted gold, they wanted it now, and the infrastructure built to serve them could not keep up. Every major Chinese bank reported a gold buying rush simultaneously. Every Chinese gold miner hit the daily limit up on the stock exchange. This was not quiet institutional accumulation happening behind closed doors. This was a stampede. Ordinary citizens, retirement savers, business owners, young professionals, all of them moving in the same direction at the same moment, toward hard assets, away from paper. And yet, Western mining stocks did not follow. Chinese miners were locked at their daily upper limit. Western miners barely moved. That divergence, quiet, unannounced, easy to miss, was either the opportunity of the cycle or the warning sign that almost nobody caught in time. There's a category of event that markets are never truly prepared for. Not because the signs were absent, because the scale was unthinkable. While China's gold platforms were crashing and Western traders were still processing silver's morning reversal, something was happening in the Middle East that would normally send every commodity market into vertical panic. Normally, but this morning was not normal. Iran had struck 15 different countries and military installations in a coordinated campaign that stretched across the most critical energy geography on the planet, Israel. The United States, the UAE, Saudi Arabia, Qatar, Kuwait, Jordan, Iraq, Bahrain, Oman, Syria, Cyprus, French military positions, Italian military positions, British military positions. 15. This was not a regional flare-up contained within one border. This was a multi-front military engagement targeting the world's most essential energy infrastructure. Simultaneously, Saudi Arabia's Ras Tanura facility, the largest oil refinery in the kingdom, processing 550,000 barrels of crude every single day, halted operations after an Iranian drone strike. That one facility alone represented a significant slice of the global energy supply chain, but the strike did not stop there. Iranian drones simultaneously hit Qatar's Ras Laffan energy complex, one of the most strategically critical pieces of liquefied natural gas infrastructure anywhere on Earth. Qatar Energy stopped LNG production entirely, completely. Qatar supplies between 18 and 20% of the world's liquefied natural gas. In a single morning, that supply vanished. European natural gas prices responded immediately, a 47% single-day explosion in price. The largest one-day increase recorded since Russia invaded Ukraine in 2022. Kuwaiti air defenses shot down 3 U.S. F-15E fighter jets. The United States canceled 41% of all scheduled Middle East flights. And then the U.S. president made a public statement that contained no ambiguity whatsoever. We have not even started. The big one is coming soon. 30% of global oil supply was effectively offline or frozen. The Strait of Hormuz, the single most important energy choke point on the planet, was functionally frozen. Every condition that markets associate with a violent upward oil price spike was present simultaneously, and yet oil was going down, from $73 to $70 and still falling. This is the moment that separates serious analysts from casual observers. When every fundamental screams one direction and price moves the other, something deliberate is happening, something with size, something with patience, and something that understood exactly what was coming before the drones ever left the ground. There is a particular kind of confusion that only hits serious investors, not beginners. Serious ones, the kind who did their homework, watched the premiums, read the signals, positioned carefully over the weekend, and then watched silver fall 8% in under 2 hours. While everything they understood about markets said it should not. To understand what happened to silver on that Monday morning, one must first understand a concept that most retail investors never learn until it is too late. Regime dynamics. Every market environment has a regime, a set of invisible rules that determine which assets lead, which assets lag, and which assets get punished despite having every reason to perform well. When a sudden supply shock hits the global economy, the regime shifts immediately. And in a supply shock regime, the order is precise and unforgiving. Gold moves first, then silver, then platinum, then copper. The more industrial the metal, the harder it struggles until the growth uncertainty fades. Silver is not purely monetary. This is the fact that separates it from gold in moments exactly like this one. Roughly 50 to 60% of silver's entire demand comes from industrial applications, solar panels, electric vehicles, electronics, manufacturing, artificial intelligence, infrastructure, defense production. When energy infrastructure collapses overnight, when refineries go offline, when LNG supply disappears and European gas prices explode 47% in a single day, every one of those industrial demand projections gets revised downward immediately. Factories slow, construction pauses, manufacturing pipelines freeze, and silver feels every single one of those revisions at once. Gold carries none of that weight. No factory requires gold to operate. No solar panel contains it. No EV production line depends on it. Gold is purely monetary, and in a growth shock regime, monetary assets lead, while industrial assets absorb the fear. That is not speculation. That is the textbook response, and it played out exactly as the textbook describes. But here is where the story becomes uncomfortable. Because textbook does not fully explain an 8% dump concentrated in the precise window before the New York Open. Textbook explains lag. Textbook explains pressure. Textbook does not explain surgical timing. Pull up the hourly silver chart from that morning. Add the 150 exponential moving average. When silver was slammed to $88 at the New York Open, it landed on that level with remarkable precision. Not $87, not $89, exactly where the algorithm needed it to land. It bounced back to $90, but the warning was written clearly in that chart for anyone willing to read it honestly. If silver loses the 150 EMA on the hourly and fails to reclaim it, the next destination is $84.90. And below, meanwhile, Shanghai spot silver was sitting at $102, or Western spot at $90. A $12 premium still completely intact even after the Western slam. Shanghai futures printing $105. The Eastern premium did not blink. Physical demand in Asia did not move. The paper price went down in the West, and the conviction held firm in the East. That divergence is not a footnote. It is the entire story, hiding in plain sight. There is a difference between a market moving and a market being moved. Most investors never learn to tell them apart. When silver dropped nearly 8% in under 2 hours on that Monday morning, the financial media offered the standard explanations. Growth fears, industrial demand concerns, profit-taking after the weekend gap. These explanations were not wrong. They were just incomplete. Because behind the clean narrative of macro pressure, something far more deliberate was operating. Something with size. Something with infrastructure. Something that does not make moves without a calculated reason. The largest holder of SLV, the most widely traded silver ETF in the Western world, at that precise moment in time was Jane Street, a $1.3 billion position. Let that number be understood properly. This is not a pension fund holding silver for safety. This is not a retail investor betting on a breakout. Jane Street is one of the most sophisticated quantitative trading operations on the planet. Their entire business model is built around one thing: extracting edge from market inefficiency. An edge at that scale does not come from waiting patiently for prices to rise. It comes from creating the conditions that generate predictable reactions, then positioning around those reactions before they happen. The mechanics are not complicated once they are seen clearly. Silver closes at $94 on Friday. Weekend premium platforms print $96 to $100. Retail sentiment explodes. Every forum, every comment section, every trading group fills with the same message. Silver is going to all-time highs. Maximum bullish conviction concentrated at exactly the wrong moment. Then Monday morning arrives, and before New York even opens. In full, silver is pushed aggressively below $90. Every late entry that chased the weekend excitement is now underwater. Every weak hand that came in, expecting a straight line to $100, is now deciding whether to hold or cut losses. And the algo is watching every single decision in real time. This is not conspiracy. This is not speculation. This is the documented behavior of concentrated institutional positioning operating in liquid markets. Mark Douglas wrote about this precise dynamic in trading in the zone. The distinction between what a market should do based on fundamentals and what it actually does based on positioning and control. Silver that morning was that lesson in live action. At billion-dollar scale, sentiment is not just a feeling in these markets. Sentiment is a weapon. And the entity holding the largest position in SLV understands that weapon better than almost anyone operating in the silver market today. When retail is maximally bullish at resistance, size distributes. When retail is maximally fearful at support, size accumulates. The retail investor experiences chaos. The institutional algorithm experiences a perfectly functioning system. These are two completely different games. being played on the exact same chart at the exact same time. And only one of them was designed for you to win. There is a signal that serious money watches above everything else. Not the headline price, not the daily percentage move, the divergence. Because when two parts of the same market stop moving together, something fundamental has already changed and the crowd has not noticed yet. On that same Monday morning, while silver was being pushed below $90 in Western markets, and oil was defying every fundamental law by drifting lower, despite catastrophic supply destruction, something quiet but enormously significant was happening on Chinese stock exchanges. Every major Chinese gold miner hit the daily limit up. In Chinese markets, there is a circuit breaker built into the system. A stock cannot rise beyond a fixed percentage in a single session. When a stock hits that ceiling, it is called limit up. It means demand was so overwhelming, so immediate and so concentrated that the market mechanism itself had to pause and say, this is as high as we will allow it to go today. Every major Chinese gold miner reached that ceiling simultaneously. Not one, not a few, every major one. Now turn to the West. On that same morning, with gold printing above $5,400, with physical stores in China running out of investment bars, with a $1,000 retail premium sitting openly in the market for anyone to see, Western mining stocks did not follow. They barely moved. The companies that sit on the gold and silver in the ground, the businesses that extract the very metal the world was desperately buying, were being priced as though none of it was happening. This divergence has a history worth understanding carefully. Historically, mining stocks do not just follow the underlying metal, they amplify it. When gold moves 10%, miners have historically moved 30 to 50%, sometimes more. This amplification effect is one of the most documented patterns in commodity market history. It is why serious investors watch miners not just as stocks, but as leading indicators of institutional commitment to the metal itself. When miners run ahead of the metal, it signals that smart money is positioning early. When miners lag behind a metal that is already moving, it signals that institutional commitment has not yet arrived, or that something is deliberately holding them back. This is the question that Monday morning placed directly in front of every serious analyst watching the data. Chinese miners locked at their daily upper limit, Western miners flatlined. Same metal, same global event, same supply shock. Two completely opposite reactions, separated by nothing but geography and market structure. There are only two honest interpretations of that divergence. The first is opportunity. Western miners are simply lagging behind a move that Eastern markets have already priced in, and when Western institutional money finally commits, the amplification effect will arrive with force. 3 to 5 times the move in the underlying metal compressed into a shorter window than most retail investors will be prepared for. The second interpretation is a warning that Western institutional money sees something in the macro picture that Eastern retail buyers in their gold buying stampede are not yet pricing. A risk, a variable, a development not yet public. Both interpretations deserve equal respect. Because the one thing more dangerous than missing an opportunity is mistaking a warning sign for one. There's a fracture running through the global financial system right now. It is not loud, it does not appear on the evening news, but it is widening. And the people who understand what it means are not talking about it casually. To understand this fracture, one must first understand the relationship between two versions of the same asset that have coexisted in financial markets for decades: paper markets and physical markets. Paper markets are where contracts are traded. Promises of delivery agreements on price numbers, on screens representing metal that may or may not exist in the quantity the contract implies. Physical markets are where the actual metal changes, hands, where the bar sits on the table, where the vault either has what it claims to have or it does not. For most of modern financial history, these two versions of the same asset have traded close enough together that the difference felt academic. That morning, the difference stopped feeling academic. Consider what was visible simultaneously to any analyst watching all three markets at once. In silver, the weekend premium on physical-backed platforms had printed $96 to $100, while Western spot sat at $93. A $7 gap between what physical buyers were willing to pay and what the paper contract claimed silver was worth. Then Western spot was slammed to $88 at the New York Open. And yet Shanghai spot held at $102. Shanghai futures held at $105. The Eastern physical premium did not move. It survived the Western paper attack completely intact. In oil, the fracture was even more dramatic and even more telling. 30% of global supply was offline or frozen. The largest Saudi refinery, silent Qatar, LNG gone, Hormuz functionally frozen. Every physical supply signal screaming that oil should be trading significantly higher. And yet, the paper price drifted from $73 to $70. Someone with an enormous concentrated short position on paper oil was absorbing every fundamental reason for the price to rise. Buying time. While physical reality built pressure underneath the surface, in gold, the fracture expressed itself most visibly of all Western spot. Printing $5,146 Chinese retail physical gold, selling at $6,129. A $1,000 premium sitting openly in the market. Not hidden, not obscure. Openly visible to anyone who looked at both numbers side by side. Physical stores in the world's largest gold-consuming nation completely out of investment bars. The largest e-commerce platform in China crashed under the weight of a population trying to convert paper savings into hard assets. All of this happening while Western spot traded as though none of it existed. This is what a crack in the paper-physical relationship looks like in real time. It does not announce itself. It does not come with a press release. It shows up as a premium, then a larger premium, then a shortage, then a crashed platform, then a $1,000 gap between what paper says an asset is worth and what a human being with cash in hand actually has to pay to own it. The question that this fracture places in front of every serious decision maker is not whether paper and physical markets will eventually reconcile. They always do. The question is which direction that reconciliation travels. Does physical come down to meet paper, or does paper rise to meet physical? And the answer to that question is the most important financial question of this entire cycle. Every signal that has been examined across this entire story points toward a single conclusion. Not a prediction, not a guarantee. A structural reality that serious decision makers cannot afford to ignore. Let the data speak one final time without emotion, without hype, and without agenda. China's largest e-commerce platform crashed under the weight of a nation converting paper into gold. Physical investment bars sold out completely across major retail stores. A $1,000 premium sitting openly between Chinese retail physical and Western spot gold. 336 trillion yuan in savings, looking for a store of value and pointing in one direction. The Shanghai silver premium of $12 survived the entire Western paper attack without blinking. Qatar's LNG offline, Saudi Arabia's largest refinery silent. 30% of global oil supply disrupted simultaneously. European natural gas up 47% in a single day. Iranian strikes across 15 countries and military installations. The US president publicly stating escalation has not yet begun. Every single one of these data points existed on the same morning, and yet silver fell 8% from its highs, and yet oil drifted quietly lower. And yet Western mining stocks did not follow Chinese miners to their daily limit up. This is not contradiction. This is the most important lesson this market has delivered in years. Price in the short term is not determined by fundamentals alone. It is determined by who controls the paper, how much size they carry, and how precisely they understand the psychology of everyone watching. The 150 exponential moving average on the hourly silver chart is the line that separates two completely different outcomes from this moment forward. Silver holds that level, and the structural bull case remains fully intact. Silver loses that level and fails to reclaim it. And the path to 84.90 and below opens cleanly. That single technical level on a single time frame is where the short-term story will be decided. But here is what does not change, regardless of where silver trades tomorrow or next week. The structural silver deficit that produced 10 consecutive monthly green closes has not been resolved. The physical premium between East and West is not closed. The paper-physical fracture that widened visibly across gold, silver, and oil simultaneously has not healed. These are not short-term fluctuations. These are structural conditions that take months or years to resolve. For the business community watching this, for the entrepreneur trying to understand where capital preservation fits into a long-term strategy. For the decision maker who understands that economic disruption creates both the greatest risks and the greatest opportunities simultaneously. The question is never whether to pay attention. The question is whether you paid attention early enough. The Gap spoke first on Friday night. China stampeded on Monday morning. The infrastructure went offline before noon. The paper market pushed silver down while physical held firm in the east. And somewhere between all of it, a $1,000 premium on gold in Chinese retail stores sat quietly, telling anyone willing to look. That the distance between paper price and physical reality is no longer a technical footnote. It is the story. And it is only getting started. This has been AU and AG. Trust the data. Invest with logic, not with noise.